with the -2 standard deviation. It's between -2 and -2.5. That is my bread and butter zone. That area right there, I am confident in the market moving to the -2, -2.5, and -3 areas of the standard deviation projections. So if you have relative equal highs or lows that are lining up with that standard deviation area, very high probability that the market is going to go ahead and draw there. So I use this in confluence with a lot of different models that I trade, but what I use it most for is for targets, like I just explained. So we would take a buy right here, right? Stop loss would be below the bullish fair value gap, and the TP would be up in here. And I'm just giving you examples on how these work and how accurate they are. But if you watch this trade play out, now one standard deviation is a great area. Let me pause this right here. One standard deviation is a great area to move stops to break even at. Whenever the market moves to one standard deviation, I will look to move my stops to break even and maybe even take some money off the table. And then I'm pretty much always full TP'd at -2, -2.5, and -3. The -4 standard deviation is the farthest target that I will take a trade to. But it's a little more rare that the market's going to move that aggressively to that -4. But I always have it on a chart to know that, hey, if I hold the runner, this could be my extended TP area. So that is how you draw it out, guys. You take it from the manipulation leg high to low in this situation, and then, you just wait for the market to move towards those targets, and it gives you great confluence and great confidence when you're actually in a trade to use your standard deviations.